In this video, I will react to a video about LandBridge. This video, LandBridge price target increased to $82 per share from Stephen McNamara. I have released a few weeks ago a video about his analysis of LandBridge, and I thought the analysis was great. Please watch this video before. This is the part 2 of this analysis, where Stephen is increasing his price target. And I didn't watch the video, so I don't know why he's increasing his price target. But basically at the end of the part 1, he said that the price target was between $60, $70, depending if you account for continued growth for a couple of months or stabilization of growth. And since then, LandBridge released earnings, pretty good guidance. They expect the EBITDA to grow 70% in 2025. So even if you have a free cash flow conversion that is fairly good, you will have a good growth for 2025. Guidance was reaffirmed. So I don't know what he will say here, and I hope this new mic will work so you will listen to the video. And we can start. It's 20 minutes long. Take a cup of tea, take a glass of water, and that's fine. We can start. Where can I put? No, that's fine. Where can I put my face? I don't know. Let's say here. I hope that's big enough for you guys.
Hello and welcome back to the McNamara Brief, where today I'm covering an update on LandBridge, ticker symbol LB. This is a follow-up on my prior long-form presentation on this company called Permian Treasure, Royalties, Land, and Data Centers, which appeared in early February 2025. But first, just to help set some expectations, let's state what the presentation will be and what it won't be. This is going to be a much more limited presentation than my prior deep dive on LandBridge. First, I'll do a brief recap on the company and my former price target. Then I'll present key updates from their latest earnings call, which was their first full-year earnings presentation as a public company and the first time year-on-year comparisons are available for LandBridge. So it was pretty important as a milestone. I'm then going to integrate these into my financial model and update my price target accordingly. Importantly, this presentation is not a full deep dive on the history, the management team, financial performance, operating metrics, etc. That was done in detail in my last presentation on this company, so feel free to watch that if you want more detail on this fascinating, almost unique business in America's most prolific oil and gas region.
Yeah, great article. By the way, if you have some time, please check his website. Most of the articles are free. The McNamara Brief. This is a good shout out. I think this is great work.
This presentation is also not financial or investing advice. For that, please consult a professional advisor. And as a quick reminder, paid subscribers get the presentation slides. Also, they have priority access on Q&A and direct messaging with me. And yeah, my inbox does fill up pretty quickly, so I do prioritize paid subscribers when this happens. Also, if you upgrade to paid, it really helps me drive more content, and it helps me grow my whiskey collection, which I have a whiskey in hand while I record this. So let's do this. But first, here's the TLDR version. My price target is updated to $67 to $82 per share. Before that, it was a little bit lower, where I had $70 at really at the high end of my range. So I've revised my range upwards. So with that, LandBridge is a land management company in the Permian Basin. Their strategy is best summed up in this quote from their S1 prospectus. I'll just quote it quickly. Access to expansive surface acreage is necessary for oil and natural gas development, solar power generation, power storage, data centers, and other oil field reclamation and solid waste facilities. Further, the significant industrial economy that exists to service and support energy development requires access to surface acreage to support those activities. And LandBridge is sitting on 273,000 surface acres in the Delaware Subbasin, which is the most prolific part of the Permian Basin, and it's absolutely critical for oil and gas development in the United States. The company is extremely new to the public market. It went public only in June 2024, so it's less than a year. And its business became very rapidly one of the most interesting stories out there. They IPO'd at $17 and rose to $62, over 300% returns within the first 6 months. Key drivers for their growth are going to be increasing this oil and gas development in the United States and other commercial developments such as data centers. I'm going to come back to data centers. That's actually a really key piece of their story. In fact, they have one deal for a data center already in hand. It's in the site selection phase, and we're going to see this show up in the financial forecast shortly. This is a new development, and there's a relatively clearer picture for a timeline to how data centers will translate into recurring royalty payments. This was not available prior to the last quarterly update.
Yep.
So I did in my past analysis of LandBridge. I compared it to Texas Pacific Land Corp. So if you're already familiar with LandBridge, you'll be familiar with Texas Pacific, and basically showed the company's in extremely good condition. Their royalty revenues were showing strong growth potential. Their royalty yield per acre was showing solid land management practices and a sharp focus on asset productivity. The royalty coverage was more than sufficient to cover all of their liabilities, so this dramatically reduces risk to shareholders. It also reduces the downside risk for investors. And LandBridge's free cash flow per share was easily covering the dividend payout, and it really gives a long runway to grow that dividend as future revenues increase.
Yeah, I covered the latest earnings report from LandBridge, and I said in this video that I didn't like the way the company gave dividends away. I don't like that the company is paying dividend, actually. Not at all. The company is at the growth phase of its life. So I don't want them to pay 1 cent of dividend. I don't want them to do 1 cent of buybacks. So this is just growth, and be efficient, high margin, high free cash flow. But yeah, I don't know if they will continue in the future. That's quite recent.
By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video.
So the company overall, very well managed, in solid condition. The key question for investors is the valuation and whether you can actually buy a piece of the company at an attractive price. And my old price target was $57 to $70 per share. It was around $62 at the time that I published that. So I thought it was actually fairly attractively priced considering the limited downside risk and the potential for the upward growth revisions. So I'm not going to cover all the assumptions here, but just key for reference. I benchmarked with Texas Pacific Land Corp, and I based a lot of the growth rate assumptions on Texas Pacific. But a key challenge in building that out was first the lack of year-on-year financials. So the LandBridge is a pretty new company. They have limited financial reporting history, so a lot of assumptions had to be baked into this to the model that I used for my valuation. And there was also no financial performance data related to data centers. And that was a key part of their growth story. So people who have followed LandBridge know that they are in prime position.
I respectfully disagree. Data centers, that's a good bonus in the growth story, but that's not the most important part, at least in the short term. Now, the majority of the growth comes from water production, water royalties. And data centers, this is the first innings of the data center story, powered lands. So in 10 years, maybe it will be the biggest growth driver. But now, it seems like water is the big thing that is moving the ship, basically.
For potentially attracting data centers, and this is really a key part of their value proposition. So at the time, I thought LandBridge was very reasonably priced. I thought the downside risk was pretty limited, actually, given the nature of their recurring royalty payments and my conservative growth estimates. And I put the downside of my lower growth scenario at around $50 per share. So I thought, okay, worst case, it goes to 50. And given that it was around 62 at the time, I mean, that's pretty limited. So I thought...
Yeah, I mean, when Stephen published this, the stock price was $62, and after this, I think it went to $70, and then back to $60. We had the DeepSeek moment, DeepSeek 2.0 moment, a lot of growth, scariness in the markets. So actually, since he published this video, this part 1 of the analysis, the stock fluctuated a lot, and you could buy at a cheaper price. I think even below $60. I think it dropped for one day below $60.
But actually, if there was any growth that was above my expectations, it would end up being a bonus.
Yep.
So usually this is my kind of company where the downside is limited and there's a lot of potential for growth to the upside. But the key part, or one of the key parts, was that given how early it was in LandBridge's life, it was really important to listen for future updates and revise the model accordingly, because it was just so new, and the financial statements at the time I did this were so sparse. So and this brings me to the latest insights from the most recent Q4 earnings, which was their first full year earnings report as a public company. And suffice to say, things are going really well. 2024 revenue was 110 million, which was up 51% year on year. Adjusted EBITDA 97.1 million, up 55% year on year. Free cash flow margins made the biggest upward move to 73% in Q4. And with this, LandBridge is really pulling away from what they say their identified benchmark companies are. And you can see that depicted on the graphic on this page. So I've had.
Yeah, by the way, he's saying that's their biggest free cash flow margin ever. Yeah, it was just because it was an IPO before. Last year, I mean in 2024, it was an IPO, so you had these external costs that affected the free cash flow margins. But now we are business as usual, as Stephen is rightly saying. This company is operating well, growing well, generating some strong free cash flow. So I don't expect the free cash flow margins to go down, to go back to where they were in 2024. We are at 73% free cash flow margins. This is exceptional. And actually, I expect this margin to continue to go up roughly 75, 80%, similar to what you can find for TPL, Texas Pacific Land. You can have an average of 75%, 80% free cash flow margin for a sustained period of time, like 10 years. I'm quite confident in this. So if you compare this to other companies, competitors, yeah, obviously this is the highest ranking company in terms of free cash flow margin.
Added the light blue bubble on the top right to show where LandBridge is now versus the dark blue bubble of the same size just over to the left of it.
Here.
And critically, in this earnings call during the Q&A, management gave guidance that the free cash flow margins would be roughly 70% long term, right? So that's their long-term target run rate for free cash flow margins, which is really helpful for building in and modeling the valuation going forward.
We already knew it. Stefan, you already know TPL, so you already had guessed in the past their free cash flow margin forecast.
Surface use economic efficiency was also way up, almost 120% year on year to $1,000 per share. And again, management gave some actually pretty optimistic guidance that they don't actually see yet an upper limit on this metric. Rather, they see the potential to hit $3,000 per acre in the medium term. That would be 3x what they're doing now. Yeah,
that's a very good point from Stephen. Very, very good point. And the thing that was quite new in their latest Q4 earnings call. They started to talk about land efficiency, economic efficiency, and they plan to continue being more efficient per acre in the future. So, yeah.
Now, that's for selected acreage. So I don't know if that covers all 273,000 acres, but nevertheless, management seems pretty bullish on their growth prospects, and that makes my growth assumptions on the previous pages look very conservative. So good news for me. And so those insights, especially the guidance on the free cash flow margins and the surface use efficiency, just weren't available in prior reporting cycles. They're very important for updating the valuation. So how did they actually compare, the quarterly results compared to my pro formas? In brief, they're actually quite a bit higher. And to sort of give an idea, the reported 2024 figures are 12% higher than my estimates, which was the basis of my original valuation model, or at least for the base year, and the calculation of my price target. So on the left, you'll see my pro forma full year revenues of roughly 98 million versus the 110 million actuals.
Wait, where do I have to look? 98 million. I don't know where to look. Oh, this one. Okay.
And I repeat this exercise for the three reporting segments. So there's three revenue segments: the surface use, royalties, and revenues. This is responsible for most of LandBridge's growth in 2024 and likely going forward.
Yes.
And I forecasted this at roughly 54 million versus the 65 million actuals. We're going to see that in that is an $8 million one-time fee, which I then take out for valuation purposes because it's not a recurring revenue stream.
Okay.
The other two, my pro formas were actually pretty close. So for resource sales and royalties, I came in at around 28.8 million versus 28.2 actuals, so not really a material difference. And oil and gas royalties, I put at 15.5 versus 16 million actuals. So I was actually a little bit more aggressive with my decline assumptions in that assumption. So that's a happy development for me.
I don't expect anything from the oil and gas royalties segment in the future. I expected this segment to decline. It's 15% of the revenues of LandBridge, and I expect this segment to decline over the next 5 years. All the growth will be from here, from this key segment, surface use, royalties, and revenue.
But the most interesting difference is that first surface use segment. That's now the biggest segment by far, has the most management attention, and critically, it's independent of commodity prices. So growth in this segment is actually better relative to other segments in that the recurring revenues are more predictable, they're more stable, they don't fluctuate as much with oil prices.
That's pretty interesting. Maybe if you watch this video right now, you are familiar with TPL, Texas Pacific Land. They are a royalty play on oil and gas, but since 2016, 2017, they have a water segment. And maybe you see some volatility in their oil and gas segment. When the oil price is low, you make less revenue. And when the oil prices are high, you make a lot of revenue. Okay. You don't have this volatility for water. And if you look at the water segment from TPL, you see that since 2016, you have double-digit growth, regardless of the environment. So what he is saying is true.
And so that's also the growth engine of the company. Other commercial developments, such as data centers, power plants, etc., they're going to generate revenues in this segment. I wish they would separate that into a reporting segment, but they don't do that. So we have to sort of work that in backwards.
To have that's a good argument. To have a reportable segment, you need to account for a certain threshold of revenue. So now the data center story is at its first innings, let's say it this way. You only have a revenue of $8 million. That's half the revenue of the oil and gas royalties. And in terms of revenue, total revenue, that's $110 million. So 8 million out of 100, that's 8%. So the data center revenue for the moment accounts for less than 8%. You have certain threshold to meet to be a reportable segment. This is some accounting shenanigans, and maybe this is easier for them to have only 3 segments. Maybe if the data center story continues to grow in the future and generates more revenue, you can expect in the next 3 years more revenue and a reportable segment, a fully fledged reportable segment. But for the moment, I don't think that's worth their time to separate, add a new segment. Come on, guys, this is just too early. Focus on the right stuff.
So digging a little deeper, so I took a look at that first segment in particular. We now have some insights on a timeline and recurring revenue from the current data center project, and from M&A activity, which has been quite aggressive and recent, as well as medium-term overall revenue growth potential. So really key things. So first, when building out the financial model, when I update the price targets, there was this $8 million one-time payment in the last quarter. I do correct for that. It's the site selection fee on the West data center project, but it's not recurring. So it's nice to have, but it's not something I kind of count on. Second, I've updated the timeline on anticipated recurring revenue for the project. Initially, the site selection phase was for 24 months, which was on paper. I had kind of used that 24 months. Management expects that phase to be wrapped up in the next 12 to 18 months.
You have 2 phases. One to select the land, the geographical stuff, and then you build the data center. And in an earnings call, the latest earnings call, I think, management said that they expect things to move more quickly than anticipated to select the geographical areas or the site selection, So things can go faster than as planned. But after this, you have to build the data center, and after this, you will receive royalties.
And from there, a 4-year construction phase would be expected, and recurring revenues in the mid-teen millions would start in year 5. That was their quote. So for the purposes of my valuation, I put in about 15 million in revenues. I still don't add any anticipated revenues for the construction phase, during which surface access rights and payments for land damage would be anticipated, although that would also technically not really be recurring revenues. And I don't have a good feel for how much those would be. But they'll be higher than the 0 that I'm currently valuing that. So take that as another piece of conservatism baked into the price target. Third, there was an insight into LandBridge's recent M&A activity. As part of their recent land acquisitions, they secured $25 million in minimum annual recurring payments. That was part of one of their land acquisitions in the last quarter. That was not available in the prior reporting periods. Fourth, Management also indicated 2 more solar deals are expected to be announced in the coming quarters, and that could further accelerate revenue growth. And finally, management gave some guidance as to their expectations on revenue generating potential per acre of land. And with that, my model can now be cross-checked against this. So this is, pardon me, best described in the 2 quotes on the page.
Good.
These are from the CEO during the earnings call. So quote, we can look at a section or 1 square mile. In that section, we can fit 1 produced water handling facility, can generate $1.5 million per year in royalty revenues. On top of that, there's a lot of acreage that just aren't being used, and so on. And when we can fill that in, call us that extra space with opportunities like solar, similar to the opportunity we announced in these earnings release, and that could usually add another $500,000 plus across that section. So actually, some pretty optimistic stuff. And then on that bottom part, I think we can do $2 million per section or per square mile, which equates to a little over $3,000 an acre. I would say this is very, very achievable. So close quote. Both extremely good news for LandBridge shareholders.
Yeah.
And these were the kinds of insights that I didn't have access to. No one did in my prior price target model. So I'm still quite conservative in how I forecast out the growth, but I'm thinking that LandBridge actually has quite a significant growth runway ahead of it, much higher than I expected, and so this is actually quite good news.
Basically, the whole thesis that Horizon Kinetics explained for us in there later, the whole thesis is working out. So you can expect much more bullish momentum for the company if things will go smoothly in the future. Nobody knows how fast they can run, but they can run very fast if they want to. They have a lot of growth ahead, and growth with a 70-80% free cash flow margin.
So so in the short version, these were pretty significant insights. So I revised my price target upwards for now to the $67 to $82 per share range. I'm personally leaning a little closer to the higher end of that range, just because a lot of my conservatism is still technically baked into the model. So some important notes. I updated the revenue forecast using the actual 2024 revenues, so it serves as an update to my base year. I also updated some key assumptions in the cash flow model. The major update is from the free cash flow margin run rate. So my old model was more conservative, so I now assume 65% margins in 2025 and 70% thereafter. That would be in line with their long-term target rate. The 2025 number of 65%, I just threw it in to be conservative. And given that the latest Q4 result was 73%, it's likely to be closer to 70 than 65. But still helps to be a little conservative sometimes when setting a price target. The remaining assumptions I kind of left largely unchanged. So the one I think is the most controversial is the base case of 7.2 to 8.5% growth. I think the probability of this growth rate going lower than that into my lower growth scenarios is actually much lower than before. I'm actually more confident that my base case presents a pretty low downside risk. So my confidence is boosted in the performance of this company. Cost of capital, 7.8%. I've got a detailed calculation of WACC in my prior report on Texas Pacific Land Corp. So if you're interested in how I got to that figure, see that. Perpetual growth rate, nothing controversial. And common shares outstanding, easy to calculate. So based on those assumptions, the base case price target for LandBridge increases to 67 to 82 per share. At time of recording, I think the price is $67. It's probably above 70, maybe a few days after that. So it's at the lower end of the range. And remember, these assumptions are pretty conservative on the growth side. I think that if they have one more quarter of high growth like the last one, I might have to actually revise my multi-year growth rates higher.
Yeah, I mean, things are accelerating for this business. So as they develop new revenues, as they make more acquisitions, the models will have to be updated every quarter and the growth rates accordingly.
Because it just doesn't seem as realistic anymore. But again, no harm in being conservative.
Yep.
And I think the downside potential of the long term at today's price levels is actually pretty limited. So that could be a key consideration. If you're a long-term value investor, again, if they pull off another year like 2024 where revenue growth goes in the 40 to 50% range, or even another couple of quarters of 25% sort of year on year, which is really not a zero probability, then I think LandBridge revises upward very rapidly, and it could make shareholders quite happy. So in short, today's share price is actually a very attractive entry point. This is a high quality, high margin, low risk business. It's a royalties business, very steady, predictable cash flows. And after this last earnings call, I'm much more optimistic that LandBridge can hit growth levels that are much more aggressive than I'm forecasting. And if they do, the stock might re-rate rapidly to the upside, and not by a small amount. For value investors, I think this company is really worth considering. Again, downside potential is quite limited. In the meantime, I'll keep listening for future insights and be revising accordingly. I'll likely have to do another revision to this model after the next quarterly call. And I think at that point, I'll start thinking more about my long-term growth for the forecast period. I would also just add key things that I'm listening for. If there's another announcement on a second data center, then I think this company's off to the races. They've got one data center right now that's in the site selection phase. That's likely to move forward because they've got a common shareholder with that one. If they get, so like that first one is really a proof of concept. If another data center gets announced, then the proof of concept is in place. I really think then LandBridge has the potential to become a hub for data centers.
And let me add something else. Now, the first data center has been signed, and this is kind of priced in, but you have some uncertainties. The moment a second data center is expected and signed, you will have a lot of hype, because one is not enough for a trend, but two data centers are enough to create this trend. And maybe you have watched a video, or if you have not watched, that's a great interview from the chairman of LandBridge, David Capobianco, that was interviewed at the end of 2024. You can just type this on the internet, David Capobianco interview LandBridge, something like this. And the goal, the vision for the future of LandBridge is to be a company with powered lands, like a data center farm in Texas. That's a very bullish, optimistic scenario. But you know how Wall Street works, right? One data center is not enough to create a trend, but two data centers, three data centers, they can create a trend that will be forecasted in their models from Wall Street. And at the moment, we'll have an announcement of another data center. I'm expecting a huge surge in the stock price, like a huge one. This business will go to the skies. This stock will go to the sky if a second data center is announced. Not today. I'm not expecting anything in 2025. I'm not even expecting anything in 2026. Maybe there will be another announcement in 2027. But yeah, the first one has to go through first.
Going forward. And that would make it an extremely valuable piece of real estate. So with that, a big thank you for listening.
Yeah.
Please visit the McNamara Brief, subscribe.
Yeah, please visit this website. You can subscribe, and I'm surprised that this website has only 4 likes on this article. It's another proof that not a lot of people follow LandBridge. You are one of the few people that are actively following LandBridge and digging what is interesting about this company. This is one of the best risk reward I've seen in a long time. This is one of the best AI opportunities I have in my portfolio. If it turns out that they are right, and for the moment the management is doing things in the perfection, they are doing things very right, they are very efficient and optimistic for the company in the future. If management continues like this, you can expect this company to grow immensely over the next decade. And maybe this is the only stock you need in your portfolio if you want to bet on AI in the future, in data centers, if we have this growth story in the future. This is a very, very well-run business. Price is not that cheap, but it's not that expensive neither. That's good. Very good analysis. Thank you, Stefan. And I'll see you in another video. Bye-bye.
If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio. Additionally, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you are blocked, if you have any questions, I'm here to help. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need to sign up, no need for your email address. Just click the first link in the description and I'll see you on the other side.